How to not lose money when trading options. David Jaffe with beststockstrategy.com, and in this video we're going to discuss the best way to not lose money when trading options. So we all know that it's relatively easy to make money when trading options when the market goes up. You can target high profile stocks that have high market caps and which are market leaders, and then you can sell out of the money put options. And that works very well. I mean, you can win 95, 98% of your trades depending upon how disciplined you are. However, what happens if you run into a situation like March 2020 or 2022 or October and December of 2018 or August of 2015? The reality is that during those situations when the VIX spikes up tremendously and some of your put options are going to end up getting tested, it's very difficult for you to not get into a margin call and be forced to close out your positions at the most inopportune time. In 2022, I lost a decent amount of money on PayPal. PayPal, I think, was trading at around $315, around $313. It had fallen to about $225 or $235. And then I sold a put option with a strike of around $220, or maybe it was less. Maybe it was around like $205, something like that. But the point is that you would think that PayPal, which at one time was valued at about $300 billion, that after it fell about 33%, that it would be a decent opportunity to sell put options with a strike price of about $200 or $215, whatever, because many people have purchased it at over $300. Well, unfortunately for me, PayPal kept going down. And even though I had sold call options against it to reduce the strike price of it, and actually on January 3rd of 2022, I actually could have closed out the entire position for a decent profit, but I didn't do it. The reality is that you don't want to be stuck in a situation where a stock that you're selling puts on is going to continue to go down and it's going to drag down the returns of your portfolio. So, what's the best way to trade options and not lose money? And the answer is you need to buy options to protect your tail risk and to protect your downside. And your primary goal should be to reduce overall portfolio volatility. And by reducing portfolio volatility, it just so happens that a natural consequence of that will be that you'll make a few percentage of profit every single month, just simply by targeting, instead of your primary goal of making as much money as possible, your primary goal should be to reduce portfolio volatility and reduce drawdowns. And by doing that, the best way of implementing that strategy is by buying options. Now, when should you buy options? These are stuff that I discuss in my course. And I'm sorry, I'm not trying to tell you, go buy my course or anything like that. I mean, I put out a lot of content for free, and I understand that the course is not cheap. So I don't want to tell you there's this magical stuff in the course or anything like that. But I do flesh out much more in detail about my feelings of when is the best time to buy options, which expirations you should target, the percentage of your portfolio that you should cover and you should hedge against a black swan opportunity, because I think I have a pretty unique perspective on when the best time to actually purchase options, the expirations, the amount of coverage that you should purchase, etc. But I really think that it's vitally important for traders to buy options, because if you don't, then you are going to have a decent amount of portfolio volatility. And remember that the losses hurt significantly more than the gains feel good. And even though many people think that it is worthwhile to only sell options, they don't want to pay for theta and they don't want to pay for time value, the reality is that there are many times when you can act as a contrarian when options are inexpensive, where you can cover yourself and you can actually make a significant amount of money by purchasing those long put options. So those are my thoughts, which is one of the primary reasons why I believe that tastytrade, which encourages you to sell calls and keep a slight amount of negative delta, in my opinion, that slight amount of negative delta that you're going to keep in your portfolio from selling call options, it's not going to be nearly enough to cover you for a 30 to 50% drawdown. Last year, Tesla fell around 70%. So even if you were short some calls, maybe at a maximum, those short calls would have protected you for about a 5 or 10% drawdown. But a 70% drawdown, I mean, that's something that oftentimes many people are going to be unable to recover from. So those are my thoughts. They've evolved a little bit, and they primarily evolved from taking a loss in PayPal in 2022. Besides that, I mean, they're basically like very minor modifications. Nuance is so important to everything. It's vitally important to understand how option prices are affected by changes in expectations and volatility, delta, and some of the second order Greeks, etc. But I think that the primary takeaway here is that it's extremely important to buy options in order to decrease portfolio volatility. And also your primary goal should be to reduce portfolio volatility. And as a natural consequence of reducing portfolio volatility, then you will naturally earn a few percentage points every single month on a consistent basis. David Jaffe with beststockstrategy.com. Please watch this video right here, or maybe it's right here. I don't really know, but I highly recommend this video because the YouTube algorithm is pretty on point. And if it thinks that that's the video that it should recommend to you, then I highly recommend it. And if you have any questions, then leave a comment below. I genuinely appreciate your attention, and thank you so much for watching.